In November 2021, Sam Bankman-Fried was worth $26 billion. He was on the cover of Forbes. He was on the cover of Fortune. He testified before Congress. He was the face of crypto, the genius who had figured it out.
He's the CEO of the cryptocurrency exchange FTX.
Politicians listened to him. Celebrities endorsed his company. The most sophisticated investors in the world gave him nearly $2 billion. Then, in November 2022, it all disappeared. Not over years, not over months, over days. $32 billion wiped out, $100 billion in customer claims. The second largest crypto exchange in the world went to zero in less than a week. This is the story of the biggest fraud since Enron. The story of how one man convinced the world he was a genius.
Only one of the nicest people in crypto, but one of the smartest as well.
Living with roommates, sleeping on a beanbag in his office.
The Michael Jordan of crypto, if you will. You said you always wanted to get rich, but not for the reasons you might expect. Can you explain that?
For Sam, his commitment to become an earn-to-giver 10 years ago was the precedent for founding FTX and his ability to maximize his financial impact for good.
He decided that he wanted to dedicate his life to doing good for the world.
While running what prosecutors called one of the largest financial frauds in American history.
I think it's fair to say that by anyone's lights, this is one of the biggest financial frauds in American history.
This is the rise and fall of FTX. Part 1. The Rise. Let me take you back to 2017. Sam Bankman-Fried was 25 years old, working at a quantitative trading firm called Jane Street. He was good, really good. He understood markets, risk, and arbitrage in ways that made older traders nervous. But he had a bigger plan. He noticed something strange happening in cryptocurrency. Bitcoin was trading at different prices on different exchanges. Sometimes the difference was huge. Sometimes it was 30 or 40%. It was free money if you could move fast enough.
Bitcoin's value reached $11,000.
$12,000, $15,000, $17,000, $18,000.
The new currency is making a lot of people rich.
So he started a trading firm called Alameda Research. The idea was simple. Buy Bitcoin cheap on one exchange, sell it expensive on another, pocket the difference.
Bitcoin, to me, it's not just an investment. It's not just maybe a get-rich-quick scheme, as a lot of people put it.
I can literally put in a trade, wait a few hours, and I'm actually able to profit from the world's largest financial market in the world.
In the wild west of crypto, this worked incredibly well. By 2019, Alameda was making enormous profits. But Bankman-Fried saw a bigger opportunity. The crypto exchanges themselves were terrible. They crashed constantly. They got hacked. They froze withdrawals. Customer service was non-existent. So he decided to build his own exchange. He called it FTX. From the beginning, FTX was different. It was fast. It was sleek. It offered exotic products that other exchanges didn't have. You could trade volatility. You could trade election outcomes. You could trade basically anything. And then came the marketing blitz. FTX bought the naming rights to the Miami Heat arena. They sponsored Major League Baseball. Tom Brady did commercials for them. Larry David did a Super Bowl ad. Steph Curry, Naomi Osaka. The biggest names in sports and entertainment were suddenly selling FTX. But the real genius was the image. Bankman-Fried presented himself as something completely new. He was the effective altruist, the guy who was going to make billions not to buy yachts, but to save the world.
And you want to figure out what you can do with it to help the world. Earning to Give is thinking about which causes, which charities save the most lives per dollar. This $100 can go as far as it possibly can to help the world.
He lived in a penthouse in the Bahamas with 10 roommates. He wore shorts and t-shirts to meetings with billionaires. He slept on a beanbag chair in the office. He wasn't greedy, he said. He was just trying to earn money so he could give it away. And the world believed him. Sequoia Capital, one of the most prestigious venture firms in Silicon Valley, invested hundreds of millions. They published a fawning 10,000-word profile titled, "Sam Bankman-Fried has a savior complex, and maybe that's a good thing." Temasek, the sovereign wealth fund of Singapore, invested. The Ontario Teachers' Pension Plan invested. Every major institution wanted a piece of the next big thing. At its peak, FTX was valued at $32 billion. Bankman-Fried was worth $26 billion. He was 29 years old. Part 2. The cracks. But underneath the slick marketing and the celebrity endorsements, something was very wrong. See, FTX wasn't just an exchange, it was two companies. FTX, the exchange where customers deposited money to trade crypto, and Alameda Research, the trading firm owned by Bankman-Fried. They were supposed to be separate. The exchange was supposed to keep customer funds safe. Alameda was supposed to trade its own money. They weren't separate at all. The first hint came in November 2022. A crypto publication called CoinDesk got its hands on an internal balance sheet for Alameda Research. What they found was shocking. Alameda's balance sheet was built on something called FTT. That was the token that FTX had created. It was basically a digital coin that FTX printed out of thin air, and Alameda held billions of dollars worth of it. Think about that. A trading firm owned by Sam Bankman-Fried held billions of dollars in a token created by another company owned by Sam Bankman-Fried. It was like a bank lending money to itself using its own stock as collateral. The crypto community started asking questions. How much of Alameda's value was real? How much was just funny money created by FTX? And then came the tweet. Changpeng Zhao, the CEO of Binance, FTX's biggest competitor, said something simple. He said Binance would sell its holdings of FTT, just in case. That was the spark. Everyone who held FTT started selling. The price crashed. And as the price crashed, people started to realize the full horror of what was happening. Part 3. The collapse. Here's what investigators discovered. FTX was taking customer money. Billions of dollars in customer money. People deposited cash thinking it was safe on the exchange. Instead, FTX was quietly moving that money to Alameda Research. Alameda used that money to trade, to make investments, to buy real estate in the Bahamas, to make political donations, to do basically anything it wanted. At one point, Alameda had borrowed $8 billion from FTX. $8 billion of customer funds, gone. When the panic started, customers tried to withdraw their money. They asked for $60 billion. FTX only had about $900 million in actual assets. It was a classic bank run. Except it wasn't a bank. It was an unregulated crypto exchange run by a 29-year-old in shorts. On November 11th, 2022, FTX filed for bankruptcy.
Tonight, the cryptocurrency world is reeling after the meltdown of one of its most popular trading platforms. The exchange, FTX, filed for bankruptcy protection today.
His company, once valued at more than $32 billion, is now seeking bankruptcy protection.
Now bankrupt FTX is asking politicians to return donations given to them by Sam Bankman-Fried.
I think it's fair to say that by anyone's lights, this is one of the biggest financial frauds in American history.
Sam Bankman-Fried resigned as CEO. The $32 billion company was worth zero. In the days that followed, the stories got worse. FTX had spent hundreds of millions on real estate in the Bahamas. They had made venture investments in hundreds of companies. The new CEO, a restructuring expert brought in to clean up the mess, said he had never seen anything like it. Corporate controls that simply didn't exist, accounting systems that were a complete joke, money that just disappeared. He called it a complete failure of corporate controls. That was an understatement. Part 4. The ending. Sam Bankman-Fried was arrested in the Bahamas in December 2022. He was extradited to the United States to face federal charges.
Well, tonight, he's in jail in the Bahamas, facing U.S. charges in what a federal prosecutor calls one of the biggest financial frauds in American history.
7 counts: fraud, conspiracy, money laundering. His trial was a spectacle. He tried to claim that he made mistakes but didn't commit fraud, that he was overworked, that other people were to blame. The jury didn't believe him. They took just a few hours to convict him on all 7 counts. In March 2024, he was sentenced to 25 years in federal prison. He was ordered to pay $11 billion in forfeiture. Sequoia apologized to its limited partners. Temasek wrote off its entire investment. The Ontario Teachers' Pension Plan had to explain to retirees why their pension money was lost on a crypto scam. And the customers? Most of them got pennies on the dollar. Some are still waiting. So what does FTX teach us? First, crypto is not magic. When people say, not your keys, not your crypto, they mean it. If you leave your money on an exchange, you are trusting that exchange, and trust can be broken. Second, the people who seem too good to be true usually are. Bankman-Fried was brilliant. He was charming. He convinced the smartest people in the world that he was different. He wasn't. Third, centralization in crypto fails. The whole point of cryptocurrency was supposed to be decentralization. No single point of failure, no one person you have to trust. FTX was the opposite. It was the most centralized exchange in the world, run by one guy who had absolute control over everything. And when that one guy turned out to be running a fraud, everything collapsed. The $32 billion magic trick wasn't magic at all. It was just a guy taking money from people who trusted him and spending it on things he shouldn't have. The only real magic was how long he got away with it.